Hi, this is Ron Janish. I'm with andrewscourse.com, as you may know, and this video is about how we're adjusting to the markets that are a bit different and in what cases we're adjusting to them. And this will show you how you can do the same thing. It's very straightforward, very easy, and actually makes just incredible amount of sense. Now, just a little background. I personally am involved with development of videos and other products for andrewscourse.com. And you just go to andrewscourse.com and click on products, and there you can go and click on there, and you can take the course and you get the videos, you get to participate in the group and all those other good things. And it's all detailed here. And we have one of this one. We have three available this month still. It's the 18th of the month, and we have a limited number every month. We don't take on too many students. And this one here, there's only one left right now. That's the where is that? That's it's not here. Somewhere else. That's the expanded course, and we also offer here. There it is. There's the massive expanded course. We only have one of those left this month. It's already the 18th. We limit that to 3 people a month, and and that's a different discussion group, different. It's a whole different thing, and it contains a massive amount of information. Okay, so that is very, very limited, and we have a maximum of 100 people altogether that can actually take this expanded course, and that's why we want to keep it going on for a while, and that's why we limit it to 3 a month. Okay, and we have never sold more than 3 a month. So, because of that limitation, we just kind of boost them over to the next month sometimes. So let's move on to what we were going to talk about originally, which is dealing with this rather spastic market. Well, here's what we found, first of all, is that sometimes we make a trade, and like this one here, we get in nice short position in here, and it would just go down perfectly. And just have some really nice moves, and it's going down perfectly. And then all of a sudden, surprise, right? And we have to get out. And then sure enough, it goes and makes new highs for the month or so, and it just does this constantly. And so we looked at this and saying, well, what's going on here? What do our losers have in common? And here's why. What we do in stocks is we're targeting stocks that have a high probability of winning, that winning, and then always the question is how much of a win are we looking for, and our typical target is about 20%. Now sometimes we'll take less than that. Let me show you, like in this case here, we were looking at less. This might have been somewhere down here was the target. Somewhere down here, okay, was the target at that time, and that would have been a little bit below the previous lows, which wasn't much more than 12 or 13%, but still that would have been decent had that gone down that much. In most cases, getting the 20% is not that difficult. As you'll see in a moment, 20% moves are actually a dime a dozen. So we're looking for high probability moves. We're looking for, so in other words, when we get in up here, maybe 1 in 10 or 20 turns out to be a loser. Okay, and then we're looking for that high percentage, and we're looking for situations where we're not risking that much. Okay, we don't want to get in down here because then we're risking a whole lot more than we are if we're up here. Okay, so we have to fine tune what we do. We have to know what we're doing. We got to use the course methods. Right? And this is absolutely straight out of the book course method stuff. So that's what we're doing. Okay. And are we going long or short? Long and short? Absolutely. Here's an example, as you course members know. This is one where we even posted it, that we're going long down here, and and this was down in the 7. Let's say it's 740. That was the high of the day. Okay, 740. That would be up around this area here would be the target, and it's going to take a little while for it still to get there. Okay. Um, that's on the long side. Here's another long side one. As you may remember, we went short this guy here, and we posted this one the other day as a nice long signal. And so here we are, and that's a long side one. And here's another long side one. Here's a long side one. Okay, this one we posted it when it was down here, and we're already up over the 20% rule. So, but more than likely it's going to go much more than that, in my opinion. So, and that's the long side. But on the short side, uh, those are really, really fun because the shorts are fast. Woo, they fast. Like this one here, we posted this beginning of July, and even put this up on CNN for the world to see. And sure enough, United Airlines went down. Now, here's the fun part of this. What is, what does, what do my longs have in common that my shorts do not? So what's different in my shorts that I'm actually taking? See, here's some shorts that I'm avoiding, like this one here. Wound up having a beautiful short signal over here. We didn't take it. Okay, beautiful short signal over here. We didn't take it. So what the heck are we doing? Now here we had a nice long signal, and that was okay. And that's because these are dividend paying stocks. Well, here's what happened. I went to a friend of mine, his name is Sam, and I said, Sam, what is different about the market today? He says, I know exactly what's different. Well, so remember, Sam is a guy he's been somebody who's recruited money managers for hedge funds and multi-billion-dollar hedge funds and stuff. So Sam believes he knows his stuff. And he said, "Oh, it's because there's this. You have this short-term trading, and that's making all the difference in the world." And I'm going, I don't think so. But I'll listen to Sam anyway. So that's his opinion. And I asked Sam. I said, "Well, what markets? What kind of a market would your technology, the stuff that you're doing, the stuff that's working wonderfully for you, what would you avoid?" And he said, 2008. Okay. He would avoid 2008. Why would you avoid 2008? His response was, too many head fakes. Okay, that I can understand. So we looked back and we said, okay, the technique that we're using today, would that have worked in 2008? And the answer was yes. So we looked at it and said, well, what's making the performance poorer in 2012? And the answer is Helicopter Ben and Super Mario, in my opinion. And here's the solution for it. It is so nice, easy, and straightforward, you won't believe it. And whatever stock system or whatever you're using, you can apply this also. What we know is Super Mario is printing. What we know is Helicopter Ben is printing. And the result is, and you can check this out, you can go to places like IB, and you can, if you have a substantial account, you can get a margin, you can get margin money for peanuts, less than 2%, and you can buy stocks with it that are paying 4, 5, 6, 7%. You can arbitrage it, okay? And then you have certain risk factors and stuff. Now, there's different ways of handling that. Way number one is you have, let's say, a system like the Andrews system. So let's say you find something that pays a dividend. I don't know, let's make believe this one pays a dividend. I don't know if it does or not, but when you get a buy signal, and this guy here, hey, no problem. But if it pays a dividend, you avoid it. You wouldn't have gone short, kind of like I did, where it only went down to here. From there to there is not 20%, even though it was in a nice short period of time. And for example, this stock here, you would absolutely avoid going short this stock here. Why? Very simple. This one is a a candidate for the high dividend arbitrageurs. Just like this one here that we absolutely won't touch, even though we had a beautiful sell signal here and a beautiful one here. But we had a buy signal here, and since this one is a dividend paying stock, look at this guy move, and quickly, vroom, past the old highs. And this was an incredibly fast move. So what appears to be happening is you have the printers massively influencing the dividend paying stocks. And so the result is when we have stocks like this one here, or we let everybody in the Andrews group know that, hey, this is one to look at as a candidate for shorts yesterday, because we already went short. And right around up here. And it's down a couple of percentage points on the day. We had no problem going short this one because it's very different than this one here. This one won't touch. Why? This one pays a dividend, a hefty one, about 4 or 5%. But this one doesn't. Same with this one here, does not pay a dividend. And this one here, that's another one we posted, and we're short. Does not pay a dividend. This one we're long. This one we're short and does not pay a dividend. This beautiful entry area up here. Boom. Okay? So the moral of the story is whatever system you use, make sure it worked in 2008, because that was a real crazy time. And for the time being, consider avoiding shorting dividend stocks, and perhaps consider giving a higher percentage of your asset allocation to dividend paying stocks. So when you have a buy signal in stocks like this one here, down here, if you take a ride this quickly in this guy, whoa, Mach 3, away we go. This is lovely. So consider dividend, whether or not dividend pays, stock pays dividend when it comes to asset allocation. Now, with futures, that's going to be a little different, because with futures, like this is a stock, but I'm really trading the futures on this one here. I'm using this one here as a proxy. And for trading, what am I trading on this one here? ZN pound F. Boom. Okay, there we go. See, this got me a nice buy signal. Okay. So here I am trading futures on this one here, and the percentage and all that kind of stuff is different. But I'm still watching what happens with the Ben and Mario stuff. I really don't want to go against Ben, Mario, and the rest of the crazies out there. And so I'm doing this on the long side. Okay? So consider asset allocation and Ben and Mario and all those guys and what they do when you're trading stocks, or even in some cases futures. They are shifting the way things work. And this is perfectly normal in an inflationary economy. Thank you for your time, and come take the Andrews course. AndrewsCourse.com. Thank you. Bye.